Before credit scores existed, someone had to look you in the eye and decide if you were worth the risk. No algorithm, no formula, no 3-digit number printed on a piece of paper that followed you around like a shadow for the rest of your life. Just a man sitting across a wooden desk in a room that smelled like tobacco and old money, asking himself one simple question: can I trust this person? And the answer to that question, the real answer, the one that nobody talks about anymore, will tell you everything about how the modern financial world was built and exactly who it was built to serve. This is not a story about credit scores. This is a story about what came before them. A system so personal, so human, and in many ways so brutal that the banks had to invent a machine just to replace it. Not because the machine was better, but because the machine could not be argued with. The machine had no face you could appeal to. The machine did not care that your father was a good man, or that your family had farmed the same land for 3 generations. The machine just looked at the numbers, and the numbers looked back at you, cold and final, like a judge who had already made up his mind before you walked into the courtroom. To understand what trust looked like before the algorithm, you have to go back, way back past the credit bureaus and the banking regulations and the post-war mortgage boom. You have to go back to a time when money itself was a social contract, written not in ink, but in reputation. And to do that, you need to understand one thing clearly. For most of human history, your ability to borrow money had nothing to do with what you owned. It had everything to do with who you were. And who you were was decided by people who knew you, watched you, and talked about you when you were not in the room. That was the world before the score, and it was a world with its own kind of darkness. A darkness that the bankers and the lawmakers and the social architects of the 20th century decided was too messy, too unpredictable, too human. So they built a cage for it. They gave it a number. They called it progress. Let us examine exactly what they buried. Picture a small town in the American Midwest, sometime in the 1930s. The streets are dirt or gravel. The buildings are 2 stories tall, maybe 3. There's a general store, a post office, a church, and somewhere near the center of town, a bank. The bank is a solid building, more solid than most of the others, and that is intentional. The building is a message. It says permanence. It says authority. It says, we were here before you, and we will be here after you. Now picture the banker. He is not a faceless corporation. He is not a toll booth with a keyboard and a credit algorithm. He is a man, and everyone in town knows his name. He sits in his office 3 days a week, and the rest of the time he is out in the community. He is at the church on Sunday. He is at the town hall meeting on Wednesday night. He watches who pays their debts and who makes excuses. He watches who drinks too much and who gets up at 5 in the morning to open the shop anyway. He watches all of it, and he files it away, not in a database, but in his mind, in the slow, deliberate ledger of human judgment. When you walked into that bank and asked for a loan, you were not filling out a form. You were being evaluated. The banker was not looking at your income statement. He was looking at your face. He was thinking about the conversation he had with your neighbor last week. He was remembering the time you settled your tab at the general store 3 days before it was due. He was also remembering the time your cousin borrowed $20 from the hardware store owner and disappeared for a summer without paying it back. Your cousin's failure was your liability. Your family's reputation was your collateral. This is what historians and economists politely call relationship banking. But let us be honest about what it really was. It was a surveillance system built from gossip and proximity. It was a financial rating based on social conformity. If you fit the mold, if you went to the right church, associated with the right people, behaved in the ways that the community considered respectable, then credit flowed to you. If you were an outsider, if you were the wrong religion, the wrong skin color, the wrong kind of woman trying to do the wrong kind of business in a town that had decided certain people did not get to build wealth, then no amount of hard work or honest dealing would unlock that wooden desk and the money behind it. The old system was personal, and personal meant powerful, and powerful meant it could be used as a weapon. So before we start romanticizing the era of the handshake loan and the gentleman's agreement, before we start mourning what was lost when the algorithm arrived, we have to sit with that truth for a moment. The system that came before the credit score was not innocent. It was not fair. It was in many ways more brutal than anything a computer has ever done, because it could deny you with a smile and call it a community standard. But here is the thing. Here is the part that keeps getting buried under the history of progress and financial innovation. The old system, for all its cruelty, was also built on something real. It was built on the idea that trust is a social fact, not a statistical one, that your creditworthiness is not a number, it is a story that other people tell about you and that you tell about yourself every single day through the 1,000 small choices that make up a life. When the algorithm arrived, it did not just change how banks made decisions. It changed how people thought about themselves. It replaced a story with a score. And in doing so, it told you something deeply seductive and deeply dangerous. It told you that you could be measured, that your entire financial identity, your trustworthiness as a human being in the marketplace, could be compressed into 3 digits. And once you believed that, once you accepted that the score was real and the story was just noise, the banks had you exactly where they wanted you. But we are getting ahead of ourselves. To understand the arrival of the machine, you have to understand the chaos it was designed to replace. The Great Depression hit the American banking system the way a freight train hits a paper wall. By 1933, nearly half of all the banks in the United States had failed. Thousands of them, not struggling, not restructuring, gone. Doors locked, windows dark, depositors standing outside in the cold, trying to understand how the place that held their life savings could simply cease to exist overnight. The trust that had been built over decades of community banking, of handshakes and personal relationships, and the slow accumulation of reputation, evaporated in a matter of months. And what came out the other side was different, fundamentally different. Because when the Roosevelt administration began rebuilding the banking system in the mid-1930s, they did not just repair what had broken, they redesigned it from the foundation. They created federal deposit insurance. They separated commercial banking from investment banking. They built a regulatory architecture that was supposed to protect ordinary people from the gambling instincts of financial institutions. And in doing so, they also began the slow process of making banking impersonal. When the federal government becomes your safety net, the bank no longer needs to know you. It needs to know the rules. And rules do not care who your neighbor is or whether your father paid his debts. Rules care about documentation. Rules care about verifiable information. Rules care about the kind of facts that can be written down, checked, audited, and defended in a regulatory hearing. The shift from relationship banking to rule-based banking was not just a change in procedure, It was a change in philosophy. It was the moment when the financial system began to see human beings not as members of a community, but as files. At the same time this regulatory revolution was happening at the top, something else was happening at the bottom. The American economy was slowly, unevenly, but unmistakably expanding. The population was moving. People who had grown up in small towns where everyone knew everyone were pouring into cities, into Chicago, into Detroit, into Los Angeles, into neighborhoods where nobody knew your name, where you were a stranger to your neighbors and your neighbors were strangers to you. The social infrastructure that had made relationship banking possible, the church, the general store, the town hall, the decades of accumulated observation, none of that existed in the city apartment block. A man could walk into a bank in Chicago in 1945 with an honest face and a solid work history, and absolutely no one in that building would know it. There was no community network to tap. There was no local gossip to consult. There was just a man and a request and a banker trying to figure out in the space of a 30-minute meeting whether this person was worth the risk. It was slow. It was inconsistent. Different bankers made different decisions about the same applicants based on nothing more than gut feeling and personal bias. The system was breaking down under the weight of its own growth. Into this gap stepped the credit bureaus. The first major credit bureaus in America were not government inventions. They were private companies, built by retailers and merchants who were tired of getting burned by customers who did not pay their bills. In cities like New York and Boston and Philadelphia, groups of merchants had been quietly pooling information about their customers since the late 1800s. If you bought a coat on credit from one store and never paid, that information might end up on a list that circulated among other merchants in the area. You would find yourself cut off, not just from one store, but from an entire network of commerce, all based on a record that you had no legal right to see or challenge. By the 1940s and 1950s, these informal networks had grown into organized companies. They collected information from banks, from retailers, from landlords, from utilities. They compiled it into files, and they sold access to those files to anyone who wanted to make a credit decision about you. The file did not know you. It did not know your name in the way a banker who had watched you grow up knew your name. It knew your transactions. It knew your late payments and your legal judgments and your addresses over the past 7 years. It was the beginning of a new kind of identity, an identity made of data rather than story. And here is where the story starts to get dark, really dark, because the credit bureaus, those early ones, were almost completely unregulated. They could put anything in your file. Accurate information, inaccurate information, rumors, court records, the opinion of a former landlord who did not like you. There was no standard for what could be included. There was no process for correcting mistakes. There was no law that said you had the right to see what they had written about you. The personal cruelty of the old system, the small-town banker who would not lend to you because of your religion or your race, had been replaced by a bureaucratic cruelty that was in many ways worse, because at least the banker had to look you in the face. The credit bureau did its work in the dark, in filing cabinets and mimeographed reports, invisible to the person it was judging. A woman in Baltimore in 1958 could be denied a mortgage and never know why. She could go from bank to bank, filling out applications, being politely but firmly turned away, and have no legal means of discovering that somewhere, in some filing cabinet, in some office building she had never set foot in. There was a document describing her as a credit risk based on information she had never had the chance to examine or dispute. She did not know the accusation. She did not know the accuser. She simply knew the door kept closing. This was the system that the credit score was designed to clean up, and in some narrow technical sense, it did. The Fair Isaac Corporation, the company that eventually gave its initials to the FICO score, was founded in 1956 by an engineer named Bill Fair and a mathematician named Earl Isaac. Their pitch to the banking industry was elegant and logical. They argued that human judgment in credit decisions was inconsistent and biased. Two loan officers looking at identical applications would make different decisions. That inconsistency cost banks money, and it cost applicants fairness. A mathematical model trained on historical repayment data would make the same decision every time for every applicant. No personal bias, no bad days, no favoritism. On paper, it sounds like liberation. It sounds like the end of the era where a banker could deny you based on the color of your skin or the sound of your last name. And it was, in one very specific and important sense, an improvement. The Civil Rights Act of 1964 and the Equal Credit Opportunity Act of 1974 both pushed in the same direction, trying to remove legally the kinds of discrimination that the old relationship banking system had baked in from the beginning. The credit score fit neatly into this new legal architecture. You cannot discriminate based on race or religion or gender. You can, however, use this number. This number that we promise is purely mathematical. This number that has nothing to do with who you are and everything to do with what you have done with money. Except it was never that simple. Because the mathematical model was trained on historical data, and historical data is just a record of the past. And in America, the past was not a level playing field. The past was redlining. The past was banks refusing to lend in black neighborhoods, which meant those neighborhoods had less capital, which meant the businesses there had less credit history, which meant the residents there had thinner files, which meant they looked riskier on paper, which meant the algorithm denied them at higher rates. The bias did not disappear. It was laundered. It was put in a lab coat and given a formula and told to stand at the door and check the numbers. The score arrived pretending to be neutral, but neutral means nothing when the playing field was never level to begin with. A perfectly objective measurement of an unjust history is still an unjust measurement. And beyond the question of fairness, there is a deeper question, a more uncomfortable question. What did we lose when we replaced the story with a score? Think about what a credit score actually measures. It measures your relationship with debt. That is it. It measures whether you borrow money and pay it back on a schedule that benefits the lender. It does not measure your intelligence. It does not measure your creativity or your work ethic or your ability to generate real value in the world. It does not measure whether you are a good neighbor or a loyal friend or a person who shows up when things get hard. It measures one thing, and one thing only. Are you a reliable consumer of financial products? The score is not a measure of your trustworthiness. It is a measure of your usefulness to the lending industry. Those are not the same thing. But the system has spent 60 years convincing you that they are. Here is the real trick. The elegant, almost admirable audacity of what was built in the second half of the 20th century. They took something that used to require human judgment and they replaced it with a mechanism. Then they took the mechanism and they made it the measure of your worth, not just in the bank, but in your life. Your credit score determines whether you can rent an apartment, In some states, it determines whether you can get a job. It determines the interest rate on your car loan, which determines how much of your monthly income goes to the lender, which determines how much you have left to save, which determines how long it takes you to build wealth. Every step of the process feeds back into the system. Every outcome reinforces the original judgment. The score does not just measure your financial life, it shapes it. And here is the part that should make you sit very still for a moment. The people who designed this system were not evil. They were not sitting in a room somewhere twirling their mustaches and plotting your subjugation. Most of them genuinely believed they were making the system fairer and more efficient. Some of them were even right about that in certain narrow ways. But the cumulative effect of their decisions, the world that their well-intentioned engineering created, is a world where your access to opportunity is filtered through a single number that you did not choose, that you often do not fully understand, and that can be damaged by circumstances completely outside your control. Miss 3 payments because you were in the hospital. Lose your job in a recession. Go through a divorce that destroys the finances you built together. Watch your credit score crater. Watch every door it was holding open begin to close, one by one, like lights going out in a building at the end of the night. And here is the cruelest part of the design. The system does not ask why. The score does not have a section for context. It does not know that the 3 missed payments happened because you were unconscious in a hospital bed. It does not care. It just records the failure, and it uses that failure against you for 7 years. 7 years. That is the standard reporting period for most negative items on your credit report. 7 years of walking around with a mark on your file that tells every bank, every landlord, every car dealership, every potential employer who cares to look that you once fell down. Not that you got back up. Not that you learned something. Not that the circumstances were complicated and human and beyond your full control. Just that you fell. The old system, the one the algorithm replaced, was cruel in its own ways. The small-town banker who would not lend to you because of who your family was, or what church you attended, or what your face looked like. That cruelty was real, and it was wrong. But at least in that system, you could walk into the room. You could make your case. You could appeal to something human in the person across the desk, because there was a person across the desk with a face and a history and the capacity to be moved. The algorithm cannot be moved. The algorithm cannot be appealed to. The algorithm does not have a face you can look in the eye and say, "Let me tell you what actually happened." So what do you do with that knowledge? If you understand that the credit score is a mechanism designed to serve a particular system and that it was never designed to serve you, then you can begin to think about your relationship with it differently. Not as a rejection of it, necessarily. The score is real. The doors it opens and closes are real. Pretending it does not exist is not wisdom. It is just a different kind of trap. But understanding what it actually measures and what it does not measure gives you a kind of freedom. The freedom to stop confusing your score with your worth. The freedom to stop performing financial virtue for an algorithm that does not know the difference between virtue and compliance. The freedom to build real wealth, real resilience, real security on foundations that the score cannot touch. Real wealth was never about the number. It was never about the credit line or the mortgage or the leveraged position in a rising market. Real wealth, the kind that sustained families and communities through depressions and wars and all the various catastrophes that history keeps inventing. was always built on the same things the old banker was actually looking for when he sat across the desk from you. Skills that do not disappear when markets crash, relationships that hold when systems fail, knowledge that earns its keep regardless of what the economy decides to do, savings that exist outside the machinery of debt. The kind of trustworthiness that does not need a number to prove itself because the people who matter can see it for themselves. The credit score told you that trust had been solved, that a 3-digit number had replaced the messy, slow, deeply human process of building a reputation over time. It told you that financial identity was something that could be calculated, managed, optimized, like a formula in a spreadsheet. But trust was never a formula. It was always a story. And the most important question you can ask yourself right now is not what your score says about you. The most important question is what your story actually says. Because one of those two things is true, and the other one is just a number on a piece of paper chasing you around like a shadow, pretending it knows who you are. It does not know who you are. It never did. And somewhere in a wooden desk in a quiet town that no longer exists the way it used to, there was a banker who understood that. Even if he used that understanding for all the wrong reasons, the system changed. The hunger stayed the same.